Hi everyone, Michael from Bullion Now, bullionnow.com.au, coming to you from the Bullion Now bunker. I'm not sure how it got termed that, but the name seems to have stuck. So we've been reviewing some of the reports that have been coming out. So this time of year, everyone tends to kind of do a review of the year that's been and the year that's coming. And trying to condense it all down. And there's been two fascinating articles in the Australian Financial Review in the last day or so. And I'm not going to read them all out, but we're certainly going to reference them and have a bit of a discussion about what it means, particularly for the gold sector. And I know, some of these economic reports can be as boring as, so I'll try and spice it up and I'll try and keep it fairly short. So the first one is actually a review or a comment by the Australian Future Fund. Now, for those that don't know, the Australian Future Fund is the government's superannuation fund effectively for public servants. It does hold a couple of other portfolios, one of them being the disability portfolio for Australia, but it's one of the largest superannuation funds, for want of a better term. You could almost call it a sovereign fund. It's closely aligned with something like the Canadian Super Fund that invests quite heavily in Australia. So a lot of great minds go behind it, and like him or not, it's headed up by Peter Costello, who, some people love him, some people hate him, and not many people are in between. But he's certainly a very intelligent guy. So it's interesting to hear from these sorts of organisations. So they kick off with Australia's Future Fund says it's repositioned its $200 billion portfolio, so it's slightly bigger than mine, for a world of higher inflation, increased volatility, lifting its exposure to select commodities, including gold, and lowering its proportion to equities, as well as being wary of regulatory risk. So it's interesting to see them actually expanding their gold portfolio. The Future Fund's never been a big gold fan, from what I'm aware of, the readings that I've done. Unfortunately, they don't give a breakdown of what component they've put into gold and whether it's actually physical or in paper assets or in companies. I suspect it's not so much in companies, because the rest of the article, if you read it, and it's in Australian Financial Review. Let me get you the date. It is December 19th, so it's yesterday at 5 a.m. So they tend to be steering away from companies, so investing in shares, and they seem to be hinting that they're going more into the commodity physical side of it. So they go on to say the chief executive of the Sovereign Wealth Fund, Raphael Arndt, said the paradigm of falling interest rates and central bank rescues has likely come to an end, which will challenge equities and bond valuations. Central banks are causing the problem, and if they didn't do that, we would have a bigger problem, which is unsustainable inflation. So it's interesting that he's kicked that one in there as a bit of a tick for the central banks. So Dr. Arndt said the withdrawal of easy money via the Federal Reserve's massive balance sheet reduction was a concept that was not adequately understood and represented an unknown factor. So we've talked about this before on the channel, where that's one of the reasons for the volatility that we're seeing around the world. No one's kind of sure how this withdrawal of so much easy money, because we've never seen easy money to this degree anywhere in the world history. And once they turn those taps off, and the way they turn their taps off, is very, very concerning for the investment community worldwide. So that's where that volatility and uncertainty is coming from. If US Treasuries are going to pay 5% interest, it's going to suck liquidity from every corner of the world, and that creates volatility in every market in every country. The Future Fund also warned Australian domiciled investors not to rely on foreign currency exposures, to provide insurance buffers in periods where risk assets are falling. Now, we've spoken about this a number of times, where we can see an environment where the price of gold goes up, and that's certainly what this article and the next article I'm going to mention are looking at. They're looking at gold going up and providing that stability. And the big elephant in the room for anyone who doesn't invest in US dollars is how is that going to relate, and then how is the broader economy going to relate to or impact on the local currency? So in our case, the Australian dollar. And they're saying, the Future Fund is saying the Australian dollar typically falls in periods of global stress, increasing the value of the asset. So it's a double benefit for Australia, or the Australian dollar, or in investors in gold in Australian dollars, because if the price of gold goes up and the Australian currency comes back, then it increases the price in local terms far more than just the increase in spot price. So it's interesting that he's going on record with that one. And then they go on to say the last real comment that I'm going to highlight for this one. It's going through the different investments they've made. Among them was a foray into commodities, including gold, which it brought for the first time in 2020. So they've only just really started talking about it. There are certain scenarios like stagflation that are driven by supply constraints where commodities do really well. We think the decarbonisation agenda will support commodity prices in general, but obviously not all commodities. So it's interesting that they're very much highlighting the fact that they're investing in gold as one of their commodities. So it's good to see that sort of support coming from, I mean, you can't say it's a government organisation, but it's certainly the government superannuation fund. So that's an interesting précis, an interesting discussion. And good to see that they are recognising the place in gold, that gold has in a portfolio, particularly a larger portfolio. The next article that I want to highlight is one produced by the, still in the Fin Review, and I think this one was done, yes, here it is, yesterday as well, December 19th in the afternoon. And this is a release by the ANZ Bank research area. So it's captioned gold to hit 1900 US in 2023 recession scenario. And it goes through a lot of good information here. So again, I'm not going to read it word for word the whole way through, but it's a great article to get hold of just to see what the big boys are thinking. These are the professional investors. Now, I'll be the first to admit that the professional investors don't always get it right, but they have far more resources at their fingertips. So it's interesting to see how they're interpreting the resources that they're seeing, how their gazings into the crystal ball go, and what conclusions they draw. So here we go. Global recession fears signal bumpy times ahead, but not for gold, according to ANZ Research, who's boosted its year-end forecast for the precious metal as investors seek safe haven assets and the US dollar rally fades. It's a welcome relief for gold believers who suffer through a nail-biting year with rising interest rates and US dollar strength neutralising gold as an inflation hedge. I really encourage you to, if you can get hold of the Financial Review, the Australian Financial Review, or the ANZ report into this, and have a read of it, because it goes through this fascinating discussion. A lot of the questions that we've had as a bullion dealer this year is, I thought gold was an inflation hedge. We're seeing inflation go up. Why haven't we seen gold increase? And like earlier on in the year, right back at the start or tail end of last year, we were seeing gold hitting a price of, it broke through 2,000 US. And then come that February, March, April sort of time, it's peaked there and it started to copper hammering the whole way down to a point where it hit a 2.5-year low of 1,600 something. I may stand corrected on that. It may have even hit, I think it hit 1,500 for, like in the 1,500s for a little while there. So it's that question of, I thought gold was always a hedge against inflation. And this article does a fantastic job of actually saying, yes, it is an inflation hedge, but when you do these sorts of things, it reduces the impact of the gold price on the inflation hedge. So we're seeing here, this is from the two analysts, so Daniel Hines and Sunny Kumari, said gold appears to be at another pivot point as inflationary pressures ease and central banks slow the pace of interest rate rises. Now, as soon as I read that, I went, hang on, they're saying that it's going to go up because inflation pressure eases. That's odd. I didn't realise that. I haven't ever drawn that conclusion before. Analysts expect gold to outperform equities over the coming year as peak rate comes into view. Recession fears are realised, raising their end-of-year target price to $1,900 an ounce from $1,700, and we're talking US dollars here. So tighter monetary policies amid high inflation are likely to slow economic growth. This backdrop is typically positive for gold. Let me skip through this part. Analysts expect to see gold retrace its gains since November lows, which is great. They expect safe haven buying to raise prices as the US enters a recession in 23 and Europe faces geopolitical risks and energy shortages, which we've talked about ad infinitum on this channel. Gold prices tend to come under pressure ahead of recessions, but then outperform other markets, such as equities, during them. As global growth slows through the second quarter amid elevated geopolitical risks, we expect safe haven buying to lift the price of gold. This year, this is where I love it. This year has been a difficult year for gold. Rising geopolitical tensions stemming from Russia's invasion of Ukraine should have been enough to keep the gold price at a record high of $2,050 an ounce, as investors sought the safe haven. But as the focus shifted to stamping out rampant inflation, synchronized and aggressive inflation rates from key global central banks, and a fiercely strong US dollar weighed on the price. Gold qualities as a hedge against inflation were more than offset by aggressive rate hikes. So what they're doing is they're recognizing the fact that gold is a good hedge against inflation, but the aggressive rate hikes nullified that normal impact. Which I think is spot on, actually. And we saw that as the rates went up, it was a recognition of inflation. But because they were seen as attacking the core source of inflation, so that excess money flowing out into the system, it nullified that impact that normally it would have. But what we're going to see now is recession fears were sustained last week after key central banks slowed the pace of rate increases, but surprised with aggressive forward guidance. So what they're saying is that because of this massive increase in interest rates, and if you look on a historical sense, it's one of the most rapid increases in interest rates that we've ever seen. It's certainly not the highest increase we've ever seen, but it's certainly the most rapid that we've ever seen. And that, it seems to be, according to the ANZ, they're really looking for, particularly the US, but US and Europe, to enter into this global recession next year. And that is where gold is going to come into its own, according to the ANZ. So trawling through data from recessions past, Mr. Hines and Ms. Kamari say gold tends to perform predictably around recessions. Returns tend to come under pressure in the 6 months leading up to the recession, which is kind of what we've been moving through recently, averaging about 2%. Before rebounding with average returns of 16% as economies experience sustained contraction. For the 6 months after a recession, gold continues to deliver decent returns. And then they go through these examples, which is really, really good. Each recession is distinct, but Mr. Hines and Ms. Kamari call out striking similarities between the 80s and today. These include the energy crisis stepping from the 79 Iranian Revolution, which pushed up already high inflation and saw central banks tighten monetary policy. And some of us with more silver-coloured hair like mine will remember this kind of occurring in the, flowing through to the 80s. Most countries experienced double-dip recessions as gold rallied from $230 US an ounce, remember those days, to reach $835 an ounce in early 1980, and then trended lower into early 82. In late 82, a second period of weak economic growth lifted the gold price more than 50%. 2007 to 2009 global financial crisis boosted gold prices by almost 60% as the world entered a deep and sharp correction in growth. So it's great that they've actually taken the older data. They've recognised the differences between the 70s, 80s, or late 70s, early 80s, and then again the 2007, 2009 GFC. But they've recognised the echoes that occur with these things. And they're actually writing that into what they're predicting. So it's good to see gold getting a bit of recognition, a bit of love around the world, both from the investment funds, so places like the Future Fund, but also from the analysts that are trawling through this data. And they're actually predicting, like we said, a gold price of $1,900 US an ounce. And I think for investors that aren't in the US or aren't purchasing in US dollars, they're producing in their local currencies, I think they're going to see far more impact on this increase if it does occur. But I think we're going to see far more impact because of that weakening Australian dollar as the world rushes to get that 5% plus interest rate out of the US. Like it or not, the US is still considered the tier one fund around the world. So if you can get 5% in the US and 5.5% in somewhere like Australia, the chances are a lot of these funds are going to say, no, let's pull the money out of Australia or out of the UK or out of Europe or wherever they're looking, and let's take a safer return in US dollars in the US, guaranteed by the US government, which is going to impact on that Australian dollar. And as I've said many times, the only asterisk I'd stick next to that is just the fact that Australia is such a commodity-heavy country. It may not have the impact on the Australian dollar quite as much as we're expecting. But I think certainly what these guys are saying, or these people are saying out there, is if you want to hedge, if you want that insurance policy, it's not a bad idea to move funds into gold. And then if you like the future fund, we've already moved some of our funds into gold for that insurance policy, that security, and that potential growth that we see during the global instability that we're anticipating in 2023. So look, a fascinating insight into, as I said, both people that are putting their money where their mouth is, so the future fund, but also people that are analysing the data that's coming through. Make some comments below as to what you think and where you think it's going to go. But as always, have a great end of the year. Have an incredible Christmas. Spend time with family and friends. Remember what the season's about, and all the best for the new year. See ya.